What is going on YouTube? Welcome back to the channel. For those of you that are new here, my name is Afzal Hussain. You can find out a bit more about me through the social media links below, or you can check out my website, which is www.afzalhussain.com. In this video, we are going to be talking about what exactly is private equity. You might have heard the term before. If you haven't, I'm sure you come across it when you enter the world of banking and finance, but I wanted to just give you a high-level overview of what private equity actually means. So let's get straight into it. Private equity literally means providing private financing for companies. In terms of its definition, this is what Google gives us. But in layman terms, what private equity is raising money and investing it into companies in order to make them perform better, and then gaining a return off of that improvement in productivity or performance. A few very prominent names in the private equity space include Blackstone Group, Vista Capital Partners, KKR, and the Carlyle Group. So make sure you check out their websites if you want to find out a bit more about their investment strategies and how they have become specialists in the private equity space and what they actually do. So it's always interesting to check that out. Go to their websites, check out some of their leadership profiles, individuals who are leading the companies, check out their history, their previous work experience, check out what they've done in the finance space. And you know, it's just interesting, so I highly recommend you check that out. As mentioned previously, there are lots of different asset classes: fixed income, equity, quant, multi-asset, alternatives. Private equity falls into the alternative investments bucket. Now, one very key distinguishing factor to be aware of whenever you are thinking about private equity is there are these two terms, the LP and the GP. The LP stands for the limited partner and the GP stands for the general partner. Limited partners are the individuals and the companies and institutions who are investing into the private equity firm. So for example, I might be the private equity firm, I will be a GP, so a general partner, who is coming up with the ideas and doing the investing, and I'm going to my clients, high net worth individuals, large institutions to give me money. The people that give me and the companies that give me money, they are limited partners, they have limited liability, whereas me, I'm a general partner, I have full liability, and I am responsible for managing the portfolio or the private equity investments and investing them in the different businesses, coming up with ideas. So the general partner is more liable than the limited partner. Private equity follows a 2 and 20 fee structure. We say 2 and 20, the 2 is the management fee and the 20 is the performance fee, but it's not always going to be 2 and 20. Some organizations might do 1 and 15 or 1 and 10 or 2 and 15, 2 and 10. So it tends to fluctuate, but the norm for the industry throughout history has tended to be a 2 and 20 fee structure. The 2 and 20 fee structure simply means you get 2% every year for managing the client's money and investing it, and the 20% is something you get if you exceed a certain return. So you might say to your clients, I will get you guys a 5% return over X amount of time period, and if I do that, I'm going to get 20%, but until I do that, I'm going to get only a 2% management fee. So you might say to your clients, over the next year, I'm going to manage your money and that's going to cost you 2%. So you're going to pay me a 2% management fee. For that, I'm going to get you a 5% return. However, if I get you a return that's more than 5%, then on everything above that hurdle rate, which is the 5%, I'm going to take 20%. So that's the 20% performance fee, and that incentivizes the private equity managers or the general partners to kind of exceed expectations and get as high a return as possible. The downside or the flip side is with private equity, the returns are great, but that comes with a lot of risk, and that's something we'll be talking about shortly. But one thing I want to mention is private equity investments tend to be quite illiquid. Now, when we say illiquid, what that means is you invest your money and it gets locked up for a long period of time. So when you're investing in other asset classes or other types of investments, you might put your money away for a few months or even a few days or weeks, and then you might get your money back. But when you're investing in private equity, you could potentially be locking up your money for a good few years. It could be 2, 3, 4, 5, even 10 years. That's the investment period, and so your money is going to be locked up. So that's one of the downsides of investing in private equity. However, the upside is the larger returns compared to the rest of the market. So if you're wondering what types of strategies do private equity investors pursue, there are 5 main types. There is distressed funding. So that's basically where you are investing in parts of a company that you think can heavily be improved. It's called distressed funding because the company is probably struggling, and so you would go in, invest in different parts of it with the hope of turning it around and then selling it off to, you know, a larger company and taking the profits, or just doing a public listing and making profits from the turnaround of a poor company to a stronger company. That's distressed funding. The second type is leveraged buyout. So this is where you literally take over a whole company, you replace the management, make sure they run more smoothly and better than they already are, and as a result you get a return from either selling that company to another company or publicly listing it and getting a return for the improvements that company has made. The third type is real estate. So this is where you're investing in real estate projects, whether it's commercial real estate, whether it's non-commercial. You are investing in property development projects, and over time, if those tend to have good rental yields or do well after being sold or in the property market, you get a return for that. The fourth type is fund of funds. This is where you are investing in a fund of various different funds. So a private equity vehicle has lots of different private equity investment ideas, and you're investing in that, and it takes like the returns across those different funds. So there's fund of funds investing. And then the last type is venture capital. So this is where you are investing in entrepreneurs to go and start companies, and then you get some equity in that idea or that company, and then you get a return. So that's venture capital. If you want me to do a video on the different types of private equity investing in more detail, leave a comment below, because right now I've just given a high level overview. But if you want more depth and color, leave a comment below and I'll try and make those as soon as possible. If you found this video interesting at all, or if you learned anything from this video, it would mean the world to me if you can give it a thumbs up, hit the like button, and let's try and get this video to 500 likes. If you aren't already, do consider subscribing to the channel, and if you are subscribed, please turn on post notifications so you get notified every week when I release a video. If you aren't already, make sure you follow me on Instagram and LinkedIn. My Instagram handle is Afzal_Hussein, and you can find me on LinkedIn if you just search Afzal Hussein. Comments and suggestions for videos are more than welcome. Leave them in the comments below, and if you have any questions, leave them in the comments below as well, and I will see you in the next video. Peace.